good, everybody? This is your man, Young Squalla. This is another Always Everything with Squalla podcast. And today we have special guest. You've seen her before, and she's going to be teaching us a lot today. I'm going to let her go ahead, introduce herself, and take over.
All right, all right. Well, good evening, everybody. Don't forget to make me back host when you can. So good afternoon, everybody, because it's not evening. My name is Letha Thornton, and I am a licensed financial coach. And I've made it my crusade or my mission to educate people, especially this audience, because I know it caters to a group of the younger generation. To teach them the concepts that they need to build a strong financial house. The key is to be educated so that you can make informed decisions. And what we keep seeing is people passing away, younger, older, whatever the case may be, and there's no life insurance in place. There's no estate. There's no nothing. And so I've made it my mission to try to close the wealth gap. It says that we are 250 years behind our white counterparts because of the fact that we are uneducated, and they've put this thing in place a lot of years ago, whether that was systematic or not, because racism was in life insurance too. They have put these things in place. So it's very, very important that we try to catch up, because it's projected that Black people will go off a financial cliff by the year 2053. And that's a big part of it, because there's no living money. So we're not retiring on time. We retire in poverty. And then when someone passes away, a family not only mourns the loss of a breadwinner, but they mourn their paycheck. So telling you a little bit more about me, I'm a mom of 3 teens, and I have a social work and customer service background. And I got involved on a part-time basis starting out just because I wanted to help families. But I was like, who's going to listen to a social worker talk to them about money and finance? So I got some licenses behind my name to make it so that I would be credible and that I'd have the knowledge to know what I'm talking about with others. So that's a little bit about me. I was saying to you about the history and how it was systematically designed for us not to have the proper education when it came to life insurance. But prior to 1981, which seems like a while ago, but it wasn't really that long ago, if you were not light-skinned enough, you could not get life insurance that would pass or grow wealth, right? So they didn't want to pay for us to get buried, so they marketed a product that would make sure that we got in the ground and maybe leave a little something. But realistically, if you are a young person and you have children, you know, working families, all of that booming and going, it puts you in a bad position because you're not able to replace your paycheck. And if you have a 2-year-old and you only have a little bit of coverage, that's putting you in a situation where putting your child in a situation where someone's going to have to take care of them, and they didn't come with your income. So they weaken the financial house of someone else, because our loved ones will gladly take our children, but they don't have the income that you had while you were still living. So that child then is a financial hardship. So that's really big, because we talk about Black Wall Street, all the things that were destroyed and taken from us. It's just time for us to get it back, right? So I'll tell you some statistics. 47% of women have life insurance compared to 58% of men. If you're a single mom, that's probably not good, right? And when women are covered by life insurance, the level of coverage is significantly lower. So it's a reason to believe that women definitely need to be educated on what kind of life insurance. If you're a single mom or you're married or whatever the case may be, we need to make sure that the financial house is strong. And life insurance is the foundation of building a strong financial house. Because if God forbid something happens, you need to be in a position where you can rent an estate. But if you really live a long time, you want to make sure that you grow an estate. So it is the foundation of the financial house, because while you're building it, if God forbid there's a premature passing, the whole financial house falls apart. Right? So I'll tell you the 4 different kinds, right? Or the 4 different, I'll say the 4 different kinds, right? So you'll hear people that say, the number one thing I hear is, I have it on my job, right? I have life insurance through my job. That's you, right?
Yeah.
But I gotta ask you, you planning to retire from that job?
Not at all.
Not at all. Do you know anybody that's ever quit, got laid off, fired, furloughed?
Mm-hmm.
Absolutely, right? So when they leave, what does that mean for their coverage?
It's over.
It's over, right? So they're going to lose the coverage. So we encourage people to put something in place that is portable, no matter where you work, because the average person stays on a job 2 to 5 years. We're not retiring from our jobs like we used to. Having something portable is important. And then let's just say you stay for a long time, but then when you decide to leave, you got health challenges. It's going to be harder to obtain affordable life insurance later. The older you are, the more things start to creep in with health challenges. And then when you want to get the kind that grows wealth, you're in a position where it's harder to obtain, if you can obtain it at all. So you are at a perfect age, young man, to put something in place ASAP that can go with you no matter what job you're working. And the goal is to build as much much savings as you have in your life insurance. So if you got a $250,000 policy, we want to make sure that you're also on track to save $250,000, because we don't want you to have life insurance for your whole life. Right. And that's a misconception. People will tell us in a minute that we need to have something our whole lives, and we don't, because our lives and what the functions of our lives change. So in the later years, you don't necessarily need life insurance, but you need spending money. So that retirement needs to be tight. If you save $500,000, you could certainly pay for a funeral with that $500,000, right? So that's what we like to teach. We don't want to teach people to have something forever. There's a whole bunch of new things going on, and we're going to talk about this in a minute, where they're trying to have people to become their own banks and use life insurance to do it. Why are we using something that you have to die to get to build wealth while you're living? Right? So they're miseducating people and telling them that they can grow money and all of this stuff and use their life insurance policy. So that's job insurance. Then there's people who have no insurance, right? So that puts us in the position of having to do GoFundMe accounts when our loved ones pass away. Realistically, with these rappers, right, that are passing away, we had Takeoff, we had PNB Rock, yep. We had some people, and there was no life insurance in place. But guess who has life insurance on these rappers?
The record label, of course. I already know.
So the record label does not want to lose whatever you would have produced while you were alive. So they get $1 million policies on these rappers so that they don't miss a beat when it comes to money. But yet the rapper themselves, who have young children and things like that, don't have any kind of life insurance on themselves. That's a backwards thought, right? We got chains, we got Jordans, we got all of these things, but these rappers don't have any life insurance on themselves. So the record label understands that it's a high risk business and it's probable that they could get killed. So they take out life insurance on the rapper. But then do you think they share it with the family? No. PNB Rock's child's mother said he never worked a job to accumulate taxes, so they can't get any Social Security benefits or anything like that. And then he didn't have any life insurance in place. So can you understand that that's another family that's going to be in poverty? Because the money he was making while he was living, after a while, that's going to stop. And that puts them in a situation where they don't have the income. The income went in the ground with him when he passed away. So we need to do a better job of educating our people. The first thing you get a record label, or really the everyday working person. You need to make sure that you have some kind of protection, even if you don't have children, because you shouldn't want your family to incur a hardship of having to try to come up with this money to bury you. And those undertakers, they are not playing. They want their money. So then you have to try to come up with the bare minimum to do a cremation or whatever. And it's just you taking an L. Let's say you got to contribute $1,000 to somebody's funeral, and maybe you have it, but that's still $1,000 that you could have did something else with, right? So we're just not really being educated on the things that we should be educated on. So I'm also going to share my screen and talk about the other two kinds of life insurance, because these are the two that you see the most. I hear people say job insurance a lot, but these are the types of insurances that people have that I want people to take a look at. So you can see my screen.
Mm-hmm.
All right. So on the left, we have what they call whole life insurance. Now, this person has $100 a month to spend, and they have whole life insurance. You ever heard of whole life?
Yep.
Absolutely. So what people get excited about, especially Black people, is that it builds a savings that you can borrow from, right? So with that $100, what they do is they take 40 of it and they buy insurance with it. So they get $50,000 in coverage for $40. Not bad, right?
Right.
And then they take $60 and they put it into this cash value savings. We get excited about cash value because we don't save money aside from what's in our policy, right? So you'll have people they'll call me and be like, do I have anything that I can borrow from my policy? But this is $100 that you're paying. You're putting it into an account to grow money. So you have a bank account, right, Squalla?
Yeah.
If you went into your bank tomorrow and said, I need to take out $500, and they told you to fill out a loan application, you got to borrow it to get it, how would you feel?
Do I already have the money in the bank?
Yeah.
Oh yeah, no, I wouldn't. No, they gotta give me my money.
And you're not trying to borrow it because it's your money, right?
Yeah.
Why do we get excited then about borrowing our own money? This is money that we are putting into an account, and they're telling us that in order to get it, we have to borrow it from ourselves. But we're really not borrowing it from ourselves, right? Because how does that work? We don't borrow from ourselves at the bank. We go in and we take out whatever is in our account. Right. The other things that people don't know is for the first 3 years or more, I seen someone's policy and it was 10 years. That $60, there's no balance. So if you have a hardship and you need to take money and it's within the first 3 years, you don't have any money growing. They say that it goes toward administrative fees. If you have a whole life policy, get it out because you'll see it plain as day. The cash value accumulation page will show you that for the first 0 to 3 years, you're not growing any money. Wow. And then when you do start to grow money, it is only growing at a rate of 2 to 4% interest, right? So 2 to 4% is not a lot of money. It's rather low when it comes to growing money. The bank gives you 1%, right? So you know that it's not growing very fast. So that's why you see that the person only saved $10,000. Then if you do have to borrow it, you got to pay it back at 6 to 8%. So it's growing a lot slower than what you'd have to pay it back if you borrowed it. So you borrow it, pay it back with interest. If you don't pay it back, guess what they do? Because they're not going to stalk you or say you defaulted on a loan. When you pass away, they're going to get it from the $50,000 that your family is expecting, plus interest. So back in 1992, Big Mama borrowed from her policy, and now it grew 6 to 8% interest. So now instead of 50,000, we're only going to give her 30.
Wow.
The family's expecting to get 50 though. So that is a problem. And realistically, if you had the money and you didn't have to borrow it, you certainly are going to struggle to pay it back, because if you borrowed it, obviously there was a need. Mm-hmm. So the other thing that people don't know is that if you pass away and you never use the cash value, the company keeps the savings. And you can see that in your policy too, or you can call customer service and they will tell you that the company keeps the savings. So if you got to borrow it to get it, if you don't pay it back, they take it from your family. And if you die, they keep it. Who did you save the money for?
Right. I have a question.
Ask away.
So that whole life policy, I've heard people encouraging me to get that one for the fact that you can borrow from it. Mm-hmm. They told me that, see, they do real estate. They borrow from it and they used it to like get like a condemned house or something and then flip it. So they were investing the borrowed money that way. Do you think that's a good strategy, or is that like, nah, no good?
Remember, there's no money that's growing for the first 3 years. The only way that you will grow any kind of money, and you still won't be able to touch it for 0 to 3 years, they're telling you you can't take the money right away, but over time you can borrow the money and do something with it, right?
Right.
But if you are you would have to overfund it in order for you to really see some investment money, like some flipping money. You would have to overfund it. So if you got it like that, a lot of people are living paycheck to paycheck. Right. So they don't have the money to overfund a policy, right? So instead of the $40, maybe they're telling you got to pay $3 something a month to overfund it, so that the money is available. And again, you still can't get it for 0 to 3 years. Dang. So you might as well just do an investment, right? A short-term investment that you have access to right away if you need it. Whatever you put in there is what's in there, and you have an instant balance, which if you look to the right, this is what we're talking about. With that, I flipped it. So instead of $40, I can get you $250,000 for $60, right? So you got $200,000 more in coverage. And then I separate the two. You should never mix your living money with your dead money. Now, people will tell you that because they hype to get you to borrow from yourself, right? But realistically, if I take $40 and I have it growing in a better interest rate, which side makes more sense? Like the 175 or the 10,000?
The 175 definitely look better.
Absolutely. And they'll tell you, oh, well, you're investing your money in the stock market. We're going to be teaching some things. If you invest your money in the stock market, don't let them fool you that stocks are bad. Don't let them fool you with that. Because this is the time where people will become wealthy, because the stock market doesn't look so hot right now. And people are going to buy their shares really low because everything's on sale, because the market is a mess. And then people will, when the market goes back up, because it always does, we're going to have some millionaires who bought low and sold high. Does that make sense? Uh-huh. So we're going to use that $40, grow your investment so you have an instant balance. So if you want to put $320 in there, you don't have to wait. If you needed to take it back that next month, it's available to you to do, right? You get a higher rate of return, so the money grows a lot faster than that 2 to 4%, which is how we can get to the 175,000. It's yours to withdraw. You are not borrowing anything, and you do not have to pay it back to yourself, right? So now that's not touching your life insurance if you don't pay it back.
So
and if you die,
I don't understand that part. So
what do you mean?
On this, so when you're withdrawing, you're taking from the 175 or the 250?
Yes. You're taking from the 175. We're not borrowing from no policies.
Okay.
So that whatever you are growing in your investment, if you grow $1,000, you're taking it from the investment part, not the life insurance. See, the on the left side, the life insurance and the cash value are together. They're dependent on each other. And if you don't, say you took the whole $10,000, you will automatically lapse the policy because they're together. All right. So with the left side, you only get one or the other. You do not get both. Right. With the right side, whatever is in your life insurance, your family gets that. And whatever you've grown in your investment, your family gets that. So that's for something that your family would get versus that 60,000 and really 50,000, because they're only going to pay what is in the face amount. They're not paying you the cash value. They're going to keep it. So you got to borrow it in order to get any of the money that you put in there. But then if you pass away, your family is going to suffer, because they're going to take whatever you didn't pay back from the face amount. So that is something that we want to stop people from doing. You hear this whole infinite banking thing, become your own bank. That's just not the way to go, because again, you're telling people to overfund their life insurance policy, when really this is the living money. And what happens if I pass away? On the right side, you have the freedom to do both. They will try to scare you and say the stock market is volatile and you shouldn't put your money there. These are people who are not investment licensed, and that's why they're telling you that. People who are investment licensed will tell you that historically the market rises and falls. You can determine what your risk tolerance is and where you want to park your money. If you are not someone that wants to lose a lot of money, your interest rate is going to be lower, but your cash flow is going to be consistently growing. So people who are not investment licensed will tell you to put your money in a policy or put your money into something where it's connected to your premature passing. They're not financial advisors. They are not licensed to do investments, because if they were, they would be telling you to do that. Because if you're looking at this, doesn't the right side make more sense?
Yep.
So that's what I'm trying to say to you. The people who are not investment licensed are going to tell you to borrow from yourself. The people who are not investment licensed are going to put you in a position that our families have been struggling in for decades. So this is some popular terms. They're all whole life, but they're variable index life insurance, IULs, the infinite banking. All of that stuff is what they're trying to teach you, but you don't have a balance right away. So if I have an emergency, instead of you teaching me to create an emergency account, you'll tell me to borrow from my policy. I had a whole life policy before I got my license, and I had a hardship. I'd been paying on the policy for 5 years, and my son needed hip surgery. He was 7. And I was like, let me see if I can borrow from this policy, because I was going to be out of work and I needed the income. After 5 years of me paying for this policy, you want to know what they told me my balance was?
What?
$17.
Wow. After how many years? 5.
Remember, it don't grow nothing for the first 3 years. Right? So there's no money the first 3 years. And then it grows at 2 to 4%. I'm going to show you something when we get together next time. But there's this thing called the rule of 72, and you can pull it up. It tells you if you divide your interest rate into 72, it'll tell you how many years it takes your money to grow. So if I have a bank account and it's growing 2% interest and I got $10,000 in there, 2 goes into 72 36 times. So it's going to take 36 years for that 10,000 to become 20,000.
Wow.
Okay. So it's growing so daggone slow. Even at the 4%, if I divide 72 into 4 or 4 into 72, it takes 18 years for the money to double. So that, again, the only way you're going to see something if you're investing in a whole life policy is to overfund it. So they're going to tell you this is what your monthly payment will be, so that when your 3 years is up, you actually have a balance. So they're putting people in a financial hardship to just so that they can have something 4 years later, and it's just not a good plan. So I'm watching this, and they're trying to teach people, and they're using their fear of the stock market when the stock market has been flowing and going since before you and I were even thought of. So they're trying to scare people into not investing their money in the market, the global economy, as they say, because they're saying, look at what it's doing, as volatile as this. But if you also Google the there's an investment trend, and you can look and see in 2008 the market took a dip, and then it bounced back up in 2016 past where it was. So that is what they're using to scare people and telling them that this is a much better plan, where really you can get in the global economy right now and buy low, and when the market skyrockets again, you're a millionaire. That's what the Donald Trumps of the world do. Anybody that's into investments and has someone advising them, not a life insurance agent, has someone advising them, this is what they're teaching them. The wealthy are not, and they'll try to tell you the wealthy are, but the wealthy are not doing this. The wealthy are renting an estate until they can grow an estate. They are not paying on something their whole life. So those are the concepts that we teach. And then, like I said, they're counting on the fact that you're not going to be able to save money, so you need to have a policy your whole life. Just doesn't it's not economically smart to do. But my parents and my grandparents did it. Consequently, when my dad passed away, I got $10,000, and that was gone before I got to college.
Well, I got a question about the term life insurance as far as the policy itself.
What's the question?
Is term life insurance, because I'm trying to remember which one was which, because I heard the way they advertised it to me was, in order for term life insurance to really work, you have to pass away within the term.
Absolutely. It's just like car insurance. You pay for straight insurance. So
if you don't pass away within the term, then you lose everything, or what?
It's the same. If you never get in a car accident, you've been paying your monthly premium, right? So it's the same. You have been covered all of this time in the event that, God forbid, something happens. But let me show you why that you want to. That's like renting an estate. In the early years, you don't have $250,000 laying around, but you got young children, you got a house or a mortgage. Let me pull up my my next slide here so I can show you why you're not necessarily looking to have, after your term is over, you need to be having some spending money. So the coverage is I'm pulling it up. Hold on. The coverage is what's important along the time that you got these young kids and you have a house or a mortgage. Those things are very, very important. But I'll show you why it's not, you're not going to get it with the whole life policy either. You got to die to get the whole life too, right?
Right.
So that's not a flex.
Okay.
You know what I mean? Like, either way, you got to die to get it. The only benefit, what people think they have, is that they are they're getting to borrow from their policy, right?
Right.
So that's what we have. Why can't I find my, hold on. I just sent this the other day. All right, there we go. So this is what I want to show you. So this is how insurance works. There's called a theory of decreasing responsibility. You can see this?
Mm-hmm.
All right. So this is why term insurance works. In the early years, you need a lot of coverage, not no 50,000. You need a lot of coverage because you have young children, a high debt, house or mortgage. A loss of income would be devastating. So we got to plug all those holes, and we only got $50,000 in coverage, right?
Right.
In the later years, you're not going to need as much coverage. Why? Because your kids are grown, your debt is lower, you've paid off your mortgage, you need retirement income. In the early years, you ain't saved no retirement income, but in the later years, you better have some money saved. So if we do a 30 or 35-year term, the goal is for you to save as much money as you have in your term policy. So if it's 250,000, when your term is over, we want to make sure you save $250,000 so that you can become self-insured, pay for your funeral off the top, unless you having something crazy that costs $250,000. But it's also designed for you to have money to live out of. This is what the wealthy do. They rent the estate while they don't have it laying around. And then once their term is over, just like car insurance, just like you could pay on something for your whole life, but it still isn't solving the retirement needs. You still gotta die to get the $50,000. And then with the cash value, it's growing so slow that what are you going to do with that? So that is what we teach people so that they don't make those mistakes again, unless they're overfunding their cash value and they still got to borrow it to get it. Does that make sense? Does that answer your question?
Yeah.
Yeah. So those are some of the things that we teach when it comes to building a strong financial house, right? You see this, you protect your income with term life so that if anything, God forbid, happens, your family is good. The problem with us is we flip the house upside down and we doing our other goals and dreams and we flossing and flexing, right? And we don't have no daggone life insurance, right?
Yeah.
So we protect our income. If something happens tomorrow, Letha's family has $415,000 and I've told my kids what to do with it, right? But when Letha's children are grown, I'm going to make sure that they do that for their children, right? And it should look a little bit like this. Not that. This. It should look like this. So we have grandpa and grandma, both got $250,000. This Proverbs 13:22 says a good man leaves an inheritance to his children's children. This is why whole life is not effective. Often it costs a lot. If you want to get $250,000 in coverage, it costs a lot to get because whole life is more expensive. Right. So child one, we make sure that with the $250,000 that they're left, that they invest $100,000 of it, and then they leave their children $500,000, right? Because that money's going to grow. So they got the money from the coverage and they have the money from the investment. So they're going to leave their child $500,000. Child two does the same. Now we got grandchildren that come. They get a $500,000 policy. They invest $200,000 of the inheritance that's left, and they leave $1 million because that 200,000 is going to grow. So then they leave their children $1 million. Same thing with grandchild number 3. Do you see the cycle of how we can stop poverty if we teach this?
Yeah.
Right? So whole life they're telling you with the thing that you saw that they're marketing to you, They're telling you, don't even worry about what you need to leave to your family. If you want to do this real estate, just get this policy and go ahead and borrow from yourself. They're not teaching you how to leave a legacy. They're saying, do this so that you can start a business or do real estate, but it's not addressing the two things that I showed you. What happens if I pass away too soon, or what happens if I live a really long time? And you're still going to need to have a vehicle for your retirement to grow. You know what I'm saying? So since you're young, they're telling you, don't even worry about none of that stuff. But that is very, very important, right? We need to create an emergency fund. So we got 3 to 6 months of our salary saved. We need to make sure that we have a will. We need to make sure we have college savings. And then you get your retirement stuff that's in order. And then you can live out your other goals and dreams. But I would much rather see you invest money that you have instant access to versus waiting till however long before you can withdraw the money. Whatever you put in that investment is yours to take, whether it's an emergency account, whether it's a long-term savings, whatever you're investing your money in is yours to take versus borrowing. So if I can send a message to anybody, stop borrowing your own money. If you won't do it with your regular banking institution, why would you do it with the money that you're using to invest? It makes no sense to do. And they're showing, oh, my so-and-so did this and they're a cash millionaire and all of that. I don't know their circumstances. I don't know how much they overfunded it with, but I've seen people overfund their policy and then they're struggling to pay everything else. When really you can get something that's affordable. I showed you $250,000 for $60, and then you start your investment and you got both at the same time. When your term is over, you now have saved $250,000 or more. And if you've saved along the way, whatever you need to withdraw is yours to withdraw. Does that make sense?
Yeah, definitely.
All right. So that's just some of the things that we try to educate people on. But I specialize in helping people to build the whole financial house, not just part of it. We want to make sure that you grow your investments as well. We can help you with the will. We can help you with everything that you saw on that screen so that you can be in a better position to leave a legacy. So that is what I would say to do. Do you have any follow-up questions?
Yeah, so like the term insurance policy, you say they invest into the stock market. Is there there's a broker that's doing it for that life insurance company?
They're separate. Remember I said that life insurance is separate from investments. So this is straight life insurance. That $250,000 you saw is straight life insurance. They are not using your life insurance product to invest it into the stock market. Okay. With the investment that you saw, so say you said, Letha, my budget's $100. I'm going to take 60 and put it for the life insurance and get you as much insurance as I can get with that $60. And then I'm going to take 40 of it and I'm going to invest that into the stock market, the global economy, so to speak, so that they're separate. Your family will get whatever was in your life insurance if your term was still going on, and your family will get whatever you invested. If it's a personal project, that money is yours. It's an instant balance immediately. So if there's $5,000 in there, it's yours to take, and you don't have to wait, and you don't have to pay it back with interest.
Cool. So
they're two separate things.
I'm just a little skeptical. I'm one of them people who's skeptical of the stock market. I feel like it's similar to gambling.
So that is what people who don't understand it say. That's exactly what they say. But this is how the wealthy have become wealthy. They have invested their money into the global economy, and they have a rate. They have a rate of return. The top wealthy people that you're looking at, they didn't do it with no policy, with no whole life policy. right? They did it investing in the stock market. And if you don't understand market trends and how it all works, yes, you may lose money, right? But if you stay the course, your money is going to come back and then some, right? Because you have to look at trends. And when you sit with someone and they show you the trends, it'll make a lot more sense to you versus just having a straight thing where because one thing's for sure, the money from a life insurance product is not connected to the stock market, right? So they are marketing as such, and they'll be like, oh, you get back dividends and stuff like that. Dividends are just really an overpayment that you pay too much and they're giving you the money back. So they'll have you all hype. Oh, you're getting back a dividend.
That is.
Yes, that's what that is. It grows dividends.
Yeah, because they tell me only do stocks with dividends because you get paid.
No. Don't get it twisted. Stocks with dividends is a profit. Oh, that is money that was made that they then give back to the share. They give to the shareholders because there has been a profit. But in life insurance, they will talk to you about dividends. But dividends in life insurance is we projected that 100,000 people were going to die, but only 75,000 people died. So we have overcharged these people based on 100,000 people to die. Since only 75,000 passed away, we're going to give them back some of the money that they paid because we've overcharged them. So that's them giving you back your money. In the stock market, that is connected to profit.
Okay.
So with the 175,000, that is connected to profit. But dividends, it's just like income tax. We all know income tax is really the money that they borrowed from you, and then they give you back what they didn't use. Mm-hmm. That's what it is when they talk about dividends with life insurance. We've charged you too much. Not as many people died as we thought. So we're going to give you back some of the money.
So at the end of the term, you get the investment money back.
At the end, you don't even have to stop the investments if you don't want to.
Oh.
You can keep the investments going. We just want to make sure that at the end of your term that you've grown money.
Right.
So that if you got to pay $10,000 for a funeral, you got the $10,000. If you need to give something to your children, maybe you want to pay for your daughter's wedding, that is your money to access. But if you still don't need to take it, you can keep the investment growing 50 years if that's what you want to do. But we want, at the end of your term, we want to make sure that you have saved money so that you can become self-insured. You don't need life insurance. In the early years, if I want my family to pay off the house if I pass away. In the early years, my children need my income. So that's what we're having a term for, because over those first 35 years, you got debt, you got mortgage, you got children, you got things that would need to be plugged if you passed away. But once say you work 35 years, you better have some money saved. So where the life insurance is cool, but if you got 500,000 that you saved, I could take 10,000, 15,000 off the top and pay for my funeral, and then my family gets the rest. Right? Versus I got a $50,000 policy, they got to pay for my funeral, and they get a trickle down of what's left. Right? Cool. So yeah, people that, if you look at those investment sites like Acorns, Robinhood, people are making money in the stock market. Yes, they are losing money in the stock market because it's not a profit every day. But I could look at my account and I can see, woo, it grew $25 today. Or, you can designate where you want your money to go. So I invest in healthcare. You know what I'm saying? You can invest in healthcare. You can invest in precious metals. I'm trying to make sure that I start to invest in artificial intelligence because I don't know if you're paying attention, but they are really trying to market these robots.
Oh, I know. At my job, I work with a bunch of robots.
So I watched, and I'm not giving, please note, I am not advising, I am not giving anyone nothing. I'm not doing that. So strike that from the record if that's what you're thinking. I'm not trying to tell people what to put, where to put their money. Just I'm telling you where I put mine.
Right.
Whatever you do is what you do. But I was watching the Eagles and what did they play? The 49ers. I was watching the Eagles and the 49ers game. I'm from Philly. And I just watched these commercials, right? And they try to make it sound so good. Like, if you're struggling to meet deadlines, consider artificial intelligence so that you can mass produce whatever it is you're trying to do. And I was just like, oh my God, like it's starting.
I actually use artificial intelligence to generate the captions for the YouTube video.
Do you understand what I'm saying? You better figure out a way, because I told my children, either you learn how to build them or you have a problem. You need to figure out something to do with them because it's happening rapidly. So that's something that I'm seriously trying to sink my money into. But those are just the things. So don't be afraid to learn. Don't be afraid to sit with someone who is investment licensed, and really they can show you time after time, even when they've invested someone's death claim, so and so passed away and he grew 100,000, and they can show you how to invest the money and live off of a percentage of it, and the rest of it will continue to grow at the rate that that it's growing at that time. So you can teach people how to only live off of a portion of it and still let the rest grow. Right. So don't be afraid. And I really would love it if you got these licenses, but we'll talk about that another time. But you'll learn a ton once you are positioning yourself. We do a financial game plan with our people that says, this is where I'm at now, this is what I have saved now. This is where I want to be. How do I get there? If you're not going to take a trip to Florida with no GPS, you shouldn't do it with your money either. Right? Where you don't have no financial destination. You just got this money sitting somewhere. You need to put it in the right vehicles so that it will grow. And then life insurance, like car insurance, when you don't have how it was explained on another podcast that I did, it's like having full coverage and then dropping down to liability.
Oh man.
Right? Yeah. Full coverage because I got these young children, I got this mortgage, I got all of these things that a loss of my income would be devastating for my teens. But in the later years, if I still need insurance, you can always renew your term, but we would prefer you not. We would prefer that you grow the money and follow the plan. So you can renew your term, but you can drop down to liability coverage, so to speak, because your house is paid off, your children are grown, and hopefully they're not sleeping on your couch. And you're now on to the next stage of your life. You don't have the same responsibilities. So you're definitely not going to need $250,000 worth of coverage. You probably are just going to need whatever you would need for your funeral services or whatever the case may be. But my goal is to see as many people as possible have grown at least the amount of coverage. If you had a $250,000 policy, I would at least want to make sure that you've grown $250,000 in your investment, so that when your term is over, I got $10,000, $12,000 for my funeral, but now I still got 200,000+ to live out of in my retirement. Right. So that is my little word of the day. And I strongly suggest that you and I sit down so you can see in real time what it looks like with your situation. Okay. Like this is what I make. This is what I got saved so far. This is what I want to do with it. Right. And I can show you in real time what your money would grow to. And I can show you how much coverage you would need based on what you have going on right now. You're young. single. Well, I don't know if you're single, but you're young, you have no
I'm
children.
single. No, just me.
All right. So your wife isn't, or your girlfriend or somebody isn't dependent on your income. So you wouldn't get no big crazy policy, but you might increase it once that happens. Once you get a wife, once you get children, and you purchase this home or whatever the case may be, you're going to step your coverage up. But as a young person, you do $100,000 policy, it would be dirt cheap. It just would. So you lock in a good rate while you're healthy, because health plays a part in the amount of coverage you can get, right? A lot of people who have a lot of health challenges, they will get a whole life policy because they don't ask as many medical questions, right? So I try to teach people, especially your audience, while you are young and healthy, lock it in, get a good rate, and then you can always increase it, and you're golden. But if you wait till you're 50 and now you got high blood pressure, you got diabetes, you got things, it's harder to get good coverage that will grow the kind of wealth or pass the kind of wealth that you're looking to pass. So before you turn 30, I want to see you put something in place. And unless, right, unless you are that convinced that over 35 years you can't grow money, then go on with the whole life. But that's what they're assuming, that over your lifetime, you can't even grow enough money for a funeral.
I know I'm about to be 30 in 2 months though, so oh no.
You need to do it. You need to do it before 2 months. Like, you need to lock in a good rate. And if you are the person that I think you are, you ain't gonna be at that job much longer either. You're gonna do your own thing. Yeah. So knowing that,
I only got that job for the insurance.
I rest my case. I could show you off air. If I show you how much coverage, like health insurance is one thing. If you got it for the health insurance,
yeah,
awesome.
I got it for all of that stuff.
I'm not knocking it. But as far as the life insurance, you lock in a good rate, you paying under $50 a month, and you lock in a good rate. When you get married and have children, you just increase the coverage. So all right.
How long is a good term length for the insurance?
I would want to see you do at least 35 years. What I try to do is set it up until people's retirement age, so that over the time, matter of fact, I can show you. I'll show you a quick example. So how we calculate insurance needs, we use a formula called DIME, right? So D stands for death. So the average funeral, we'll say, is $12,000. So that's covered. Income. If a person brings in $3,000 a month, let's just say, and that's $3,000 a month, so that's times 12 months, times, say they got a 2-year-old. I will ask them, if you passed away prematurely, does the money need to come in until the child is 18 or 21? A lot of the times they say 18. So I know that this money needs to come in for 16 years, right? Maybe they don't own a home, so we don't have to pay off the house. All right, bet. I ask them, is there anything you want to leave to your children for education? They say, I'd like to leave $100,000 for education, right? So then what I will do is I will add up and I'll say, okay, I'm using my little calculator here. I'll do 3,000. Mind you, this is based on what they tell me. Somebody's numbers could be different. Maybe their number is 2,500, but I'll do 3,000 times 12 months in a year, and then times 16 years, because that money needs to come in till that baby is 18. So that adds up to $576,000. The job gives you 1 year of your salary, maybe 2, right? So if a person makes $50,000 a year on the job, You're about to be short because this is what you need and this is what the job is giving you.
Mm-hmm.
Right? So then I'll say 576,000. Is the education still what you want to do? They say yes. So then now we're at $676,000 for coverage. That's a scary number, right?
Yeah.
That's a scary number. What would you think that something like that would cost a month?
Like a month?
Yeah.
For how many years?
That's for 35
For
years.
35 years at that number?
Yeah. How much do you think that would cost you?
Per month, like what?
Yeah, tell me what you think it'll be a month.
7,000.
So what'd you say?
5 to 7,000.
5 to 7,000 a month. That's a lot of money.
Yeah.
Who has that?
Am I right? Is that
No,
it?
you way off. But we're gonna talk about it in a minute. Some people be like, it would cost me probably 300 or whatever, 300 a month. But we're gonna look at. I'm actually doing a quote while I got you on here, so that you can see how absolutely affordable life insurance is and why term is a better way to go than sinking your money into a policy that you got to borrow from. So let's see. All right. So I'm going to do it on you. I'm going to do it at the age that you are currently. Are you a smoker?
Not cigarettes.
Okay. So, and you're age 30.
Yeah.
Well, 29. We're going to say 29 because you're not 30 yet.
Yeah.
All right. And we're doing a 35-year term. And I'm going to put in, now understand, when you get in $676,000, they may want to do a blood and urine on you to make sure that you're healthy. Let me change this. Precision. And we don't have any children, so I'm going to take that off. Now you said it would be $5,000 to $7,000 a month.
Mm-hmm.
Do you know that for $676,000 on a 30-year-old man, it would be
$100.62.
Yes, sir. So you were way off, right?
Yeah, that's crazy.
You were way off. This positions you to pass wealth. And if you said, Letha, I could do $300 a month, and then, so I would take 100 of it and I would put it into the life insurance. But then what I would turn around and do is I would take the other 200 and I would put it into an investment. So if I put it into an investment and say it's $200 a month, and let's just say 9%, that's a number that I think is reasonable. And 9% interest, and you do that over the time that you have the 35 years that you're doing the life insurance. And you're contributing $200 every single month. How much money do you think you would have over a 35-year period?
In the investment?
Mm-hmm. This is what I took the other 200. I put 100 with the life insurance. I took 200 and put it in an investment. How much do you think you would grow over 35 years?
After 35 years. Let me see.
Don't try to do the math, but let me just show you. Just from that $200 you put in every single month.
Wow.
Do you need life insurance after your term is over if you did this?
Not really. I mean, if you don't
what is it that you would need it for? Can't you pay for your funeral off the top? Can't you break your kids off with an inheritance if you so chose?
How much do funerals usually cost?
Between 12 and 15,000, and cremation is less.
Well, yeah, you got it. You got it with that.
I tell you this, it ain't no 597,000 for no funeral.
Even so if this is expensive funeral, it ain't that much, right?
No, even if you releasing doves and you got a horse and carriage and you got glitter all over it, it ain't. It is not supposed to cost no 597,000. This is how wealth is created. If I make sure you have 676,000 for 35 years and tell you do not deviate, make sure you put your $200 in your account for your investments every single month, and you grow almost as much as you had in your term policy, if the number only goes up the more you have to invest, you can see that there's no need to pay on nothing your whole life. Not to mention, along the way, while you're saving it, if you ever need this money, you do not have to borrow it. It is yours to withdraw. You know what I'm saying? And you don't have to pay it back. So your family will get that 676,000 if it's within your 35-year term, and your family will get whatever you grew in your investment. So that is what we teach, and this is how legacies are passed. This is how wealth is created, and then you just make your children repeat it and put it in your will that if you get 676,000 and you got 2 children, you make them do the same thing. Take 250 of it and invest it. And take 200, get a $250,000 policy and invest 100,000 of it. And then that's how they correct this whole generational poverty thing.
That's cool. And it's crazy because it seems it's very simple.
It is very simple. Why it's not so simple? What complicates it is because there are people who make a lot of money off of selling whole life insurance. They're not investment licensed, and they get paid quite a bit off of teaching you to go borrow your own money. Whoever offered this to you, ask them, do they have it? Because if they got a term policy, then they understand, and they're just cheating you. Okay? Because they understand that term policies pass wealth. And if they're overfunding their life insurance, God bless them, but that's not what we want to teach here. We don't ever want to teach people to borrow their own money.
Gotcha. So I'm gonna show them this video.
You do. You need to show it to them, and if they want to sit down and meet, tell them I want to meet with them and you at the same damn time, right? So that they can sit and tell you, because we're gonna pull up a policy that they did, that they've written, and show that we're gonna look at all of this stuff the way that we need to look at it so that you can learn it. Hey, show us a policy that you did. And when they show the policy, the whole borrow your money thing, how much will they be able to borrow right away? Or how long do they have to wait before they can borrow from themselves? Right? And then overfunding it with people who live in a paycheck to paycheck cycle, people should be ashamed of themselves that you would encourage people to overfund a life insurance policy to get something in the next 3 years. It's a miscarriage of justice, in my opinion, because you're positioning people to be ripped off. So I'd love to sit down and meet with them and let them tell you why this is good to do. Right. So, any other questions?
Oh no, those are all my questions.
All right, cool. If your listeners have any questions, they can feel free to reach out to me. I would love to show them not just the life insurance, but what the living money looks like also. The same way that I just did your example, I can do their example so that they have an idea of what they need to do to be on target. They can look me up. I'm on Facebook. My name is Letha, last name Thornton, Thornton. They can reach me at 610-800-9449. Again, 610-800-9449. And let's just all level up together. You know, let's get this money right and start to leave some inheritance, especially since we are becoming business minded, and we are understanding that we need to start businesses and things like that. Entrepreneurship is on the rise.
Right.
So we just want to show you how to make some better steps with your money and change your financial landscape. So if anybody wants to reach out, feel free to do so.
Definitely. And I will put all of that in the description of the video.
Very, very good. And then you and I, like I said, you need to see what your financial picture looks like sooner than later, based on the money that you have saved so far. You need to see if you're short or if you're on target.
I'm pretty sure I am short right now.
Most people are, but I didn't want to say, I know you ain't on target, you know. So most people are, because they're saying for every decade you should have 100,000 saved.
Yeah, that's not that's crazy.
So we got some work to do. So I'm so glad that
they say that, but then they got jobs that only make 50, 30,000. That's job make
ding, 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 ding. We are not being paid what we're worth, and that's why 47 million people quit their jobs during COVID. It was called the Great Resignation. You can Google it. The Great Resignation. People understood that they could start businesses. That some people took their stimulus money and went and started a business. I know somebody that started a trucking company, because they understand that the job just isn't designed to pay you what you're worth. You're worth so much more, and they're giving you pennies, right? You go in and ask for a raise. Listen, I need an extra $5,000 every month because I got some things I need to get done. They're going to tell you, if you don't get out of here, they're going to walk you out with your white box and tell you, go ahead and find that $5,000. They're just not paying us what we're worth. So knowing that, we got to position ourselves and take some steps to get some things done. So that's what I would say.
Ooh, I appreciate you for the lovely lesson. I definitely learned a lot.
Absolutely. And if you get a chance this Tuesday, I too have a show called Your Money Matters Financial Empowerment show every Tuesday. We will be talking about investments. So we will be talking about how the market works and why you should not be afraid.
And where do I find that show?
So that show is, you can search it on Facebook. It's called cmpradio.net. That's the name of the station. And I will have a link posted on my actual Facebook page so that you can just click. But it is also on YouTube. If you type in CMP Radio, you can see the shows as well. It will be a live show. So the replay won't be available till after the show is over, but you can tune in and watch in real time on Facebook.
Cool.
All right. I'm going to have my mentor on there, and she's going to be doing a journey through investments from start to finish, how it works, how it looks, and why we should not be afraid.
Cool.
All right.
Thank you.
Thank you for your time. I hope you have a good rest of your day, and I hope you get some positive feedback from this. It's time, y'all. It's just time.
And we're going to do it again. We're going to keep going.
All right.
Whatever your next lesson going to be, we ready.
I love it. All righty. I'll talk to you soon.
Thank you.
You're welcome.